Olivia, the Nobel Prize that matters most to Wall Street, that of course would be the Nobel in Economic Sciences. And this year it goes to a Frenchman. Jean Tirole is a professor at the University of Toulouse. He was recognized for his work on imperfect competition, oligopolies, and the role government can play regulating such industries. Professor Tirole is with us on the telephone, and our economics editor, Michael McKee, is here too. Professor Tirole, congratulations to you.
Thank you very much.
How do you feel?
Well, I feel great, obviously. It's unexpected, but it's a wonderful feeling, and I'm very pleased for everyone, for the family, for the colleagues, for everyone.
We mentioned that you were recognized for your work studying imperfect competition and regulating such imperfect competition. How would you apply your research to the banking industry right now?
Well, to the banking industry, we have to realize that the crisis starts before the crisis itself. Actually, it's prepared. It was prepared in 2005, 2006 in particular. We need strong regulations that are going to prevent banks from gambling with taxpayer money. Banks, not only retail banks, but also investment banks, if they are to be bailed out, they also have to be regulated. Regulation is not about preventing firms and banks from functioning. Actually, it's the reverse. Regulation is about rules of the game and also an independent enforcement of the rules of the game. So that's basically what we are trying to do, we being the researcher doing industry organization.
Professor Tirole, do you feel that the regulations that have been implemented in response to the crisis are achieving the desired results, or do we still have banks that are too big to fail?
It's still too early to tell, actually. I think there have been a lot of improvements, like more emphasis on liquidity, for example, trying to reduce counterparty risk for banks and the like. The banking union in Europe, I think, even so the devil is in the detail, the banking union in Europe will be very important to get more discipline. So I think there are good reforms. Now it's still too early to tell. So, for example, if you think about the banking union, the key thing is how much discretion will the ECB have in order to downsize banks which are undercapitalized.
Professor, one quick follow-up there, though. If we look at countries like Germany, for example, or Britain, or Switzerland, or France, it appears as though post-crisis regulation, by enshrining size and creating these national champions, has made banking less competitive, not any more competitive than it was before.
Well, there's been a tendency to renationalization in general. I think that there is some competition. The main thing is to get the banks to not to take too much risk, I mean, to be capitalized and the like. So, at the world level, there is competition. I mean, probably not enough for an industrial organization, economists like me. But the main topic right now is about whether they can fail and be bailed out. By the way, size is a complex matter because you can be a very big bank but be pretty diversified. And conversely, we have seen that smaller banks can also fail. Just remember Spain and the Cajas or LTCM in the U.S. or the Landesbanken in Germany. It's not only size that matter. Of course, when it's big, too big to fail is a big issue, of course, I agree. But more generally, there's the issue of how to regulate the banks in general.
What do you do with an industry that is an important link in a production chain but is basically run by a monopoly or an oligopoly? A lot of people pointing to your comments, say, on Google. You could look at operating systems for computers like Microsoft or even payment systems. There are only several in the world that are in wide use. How do you regulate those, and are they properly regulated now?
Okay, so in Toulouse we built a theory, or what's called a two-sided market theory, which try to understand these new business models in which a firm, a platform, is trying to attract multiple sides in the same market. So, for example, you mentioned payment cards. A platform like American Express or Visa or MasterCard or PayPal as to attract cardholders and merchants at the same time. We have proposed rules to regulate the interchange fee. So the interchange fee is a fee which is paid by the merchant bank to the cardholder bank, which was deemed too high by the merchants. And actually, the rule which was proposed actually is now the official rule in the European Union, trying to understand at what level this interchange fee should be set. Now, those markets are kind of special in a sense. You probably have noticed that often prices to one side are zero or even negative. I mean, if you think about Google, you mentioned Google, we as users, we get a very good deal. We don't pay, and we get all those services, search, email, and so on, for free. So it's like a negative price in a sense. And of course, there's a trick, which is that the advertisers pay on the other side. So lots of the business models which have emerged have tried to understand how to basically bring both sides on board while still making money. You mentioned monopolization, which is an important topic. Those industries tend to be highly concentrated. Not the payment industry, because remember, Visa and MasterCard, for example, have about 7,000 members, so they serve a lot of banks. But if you think about Google and so on, those are heavily concentrated, and I think there the competition is more dynamic, which is that a leader is replaced a few years later by another leader, and what antitrust authorities are trying to do is that the other leaders can emerge when they have something to offer. Not, of course, to help competitors who are weak, but rather to allow leaders to be challenged by strong competitors.
Professor Tirole, we congratulate you once again. Thank you for spending some time with us here on Bloomberg Television. He is Jean Tirole, winner of the Nobel Prize in Economic Sciences. He is a professor at the University of Toulouse in France.